the idea here, as I've been explaining this to some people, is at a minimum, this is going to be a great way to open dialogue for getting clients off the fence. When I say clients, sellers, we're talking, I think this is primarily, I want to focus this conversation more towards sellers than for buyers. Buyers want to buy, sellers just don't know what to do yet. So that is what we're doing here. Focus, I'm going to say focuses on sellers because, again, I've mentioned this once before, and this is a NAR stat that I read. 2/3 of home buyers are selling at the same time. When we say home buyers, they're really home shoppers. 2/3 of the people that want to buy are selling a home at the same time. 2/3 of the people that want to buy. Now, the stats might be different of the actual people that are successful. That stat might be a little bit skewed because people that are unencumbered by a current home or current mortgage, they're able to, beat out people with home sale contingencies. But that doesn't negate the fact that a lot of people own homes, want to buy another home. They're either downsizing or right sizing, or they're upsizing. Now, for those of you that are not that familiar with the market, you don't have to agree with this graph here or this chart, but the traditional buying process is, may not be spelled out exactly with this 6-month process here, but I would say in our market, when I talk to potential buyers, they certainly are excited. That's the fun part, looking for homes. Can't buy till the old house sells. We deal with a lot of frustration and disappointment. Somebody nod their head. Would you agree? Frustration and disappointment for starters. I would also say fear. We get into frustration. We get into the fear piece. I don't know that people are getting angry, but if they're lucky enough to go through this process, person I just talked to minutes before this call, bought a house a year ago. They were so flustered, stressed, and scared for the whole process that's another real estate agent actually bought a house a year ago. They would have loved to use this product or something like it. Anxiety through the process and paying 2 mortgages, or the fear of paying 2 mortgages in the way many people are doing this now. We're looking to eliminate that. In a nutshell, it could be as simple as this. Buy a home now, move in to the new home. Prep your old home. This is for people that haven't done any of the prep work, although I think in our area that most of the sellers I talk to, they've done a lot of the prep work. They know they want to sell. But for those that aren't even ready, they could actually be out looking to buy and move into that home and be prepping their old home. They don't have to do a simultaneous close in this case. We've been trying to structure so many transactions for people to sell their home, to buy the new home, and then quickly list their old home so that they aren't carrying 2 homes. And so they can pull the equity out of that old home. This is going to solve pulling the equity out as well. So in this case, buy the house, prep the old home, list the old home. This would all be happening during the process of the new home. And then after you've bought the new home, then sell the old home. It's unconventional, it's untraditional. We're going to get pushback on it from consumers, but that's only because they may not understand the process. So we're going to use this. We're going to use this to remove sell contingencies. Right? We know that's huge. I don't know how many, I don't know the stat, but I know our company, of the thousands of loans that we did in New Jersey, that's not me, I didn't do thousands myself, but our company, our region, North Jersey, the thousands of loans that we did in North Jersey, very few offers were accepted with a home sale contingency. That's very rare. I probably did, I was part of one first thing this month, earlier this year, pardon me, one this year, or maybe one last year. So here are the key benefits. I'll just use I'll use an example of somebody that owns a house free and clear. This might be ideal for that person. That, again, as I'm going through these options, please keep in mind, this is just an option. When all other options seem to be failing or too scary, not worthwhile, or more costly, this is going to be a viable option. So access up to $500,000 in equity. Of course, based on everything's going to be based on qualifications, as the asterisk says. So if somebody owns a house free and clear, they could take money out of the house, use it for a down payment on a new house. That's going to help remove the home sale contingency. The down payment and the deposit on the new home, that's one major obstacle. When I go through the 2 main obstacles of people that own a home already, one obstacle is coming up with the money for the down payment. That's an obvious obstacle. They got equity in the house, they just don't know how to tap into it. The other obstacle is qualifying to carry their current mortgage and now possibly an equity loan or an equity line, which is a common solution, and then the new mortgage. So they can do a down payment of up to 30% on the new home. It could actually be more. Again, it's case by case. We're going to, so let's say somebody borrows from this program $500,000 to use for a down payment on another home. We're not going to be charging a payment for that. We collect a fee up front, which I'll get to. There's going to be a fee collected up front for that. But what separates this from any other bridge loan that I know of, or what separates this, if you're thinking, well, why not just do an equity loan or an equity line? The key difference that answers that is we're not holding that payment against them. So if they borrowed $500,000 at a cost of, that's over $600 per 100,000, that's $3,000 a month. So if somebody borrowed that much money, that's $3,000 a month that would normally go towards that payment at a prevailing rate. We don't have to count that payment against them. So they will qualify more easily to take that money out because we're not holding the payment against them. And when you keep that peace of mind, I don't know that it's spelled out all that well in these slides. That's one of the things I noticed that was missing. Keep in mind, the qualifications are going to be easier for somebody to do this because we're not holding that payment against them. Whereas if somebody borrowed $100, $200, $300,000 on an equity line or an equity loan, we're going to have to hold that payment against them. It's going to make it more qualified. I have another client we're working with right now. We told him about this product, told him how it worked. We said, don't go to your bank for the bridge loan. He went to this bank for the bridge loan. Now we have to count that other company's bridge loan payment in our debt to income ratio. It was a close call, but we got on to qualify, but it was not easy. If they just followed our lead, we wouldn't have had that issue to contend with. Here's a nice feature for some: home prep for the listing. So let's say they haven't done any due diligence, or the house is cluttered. House needs new mulch, some sprucing up outside, paint inside. Part of the funds that we lend them, we will let them allocate up to $35,000 to use towards sprucing up the property. That's another huge incentive to use this. So they can maximize. If you think as an agent, your recommendation might be, fix up that, fix something up. It can't be major. We're not doing a renovation loan. We're talking about sprucing up the property. Again, I'll use paint, as an example, putting mulch down around the property, whatever, a little bit of landscaping, curb appeal, affect that curb appeal. If they truly have no money to work with, this is a great tool for them as well. And another use of this money. Now I talk about qualifying, a challenge that many people face. Forget the fear of carrying two mortgages. The challenge that many people face when trying to do this scenario, buy another home before they've got a bona fide contract in hand to sell theirs, debt to income ratio still comes into play. Not every one of us, or not everybody in North Jersey, I'm not saying I could either, is in a position to be able to carry two mortgages at one time. So if they've got consumer debt, or perhaps a second mortgage already, and those debts, Rick and I, those of you that know Rick, we had a couple that they struggled before this product came out. They had a lot of consumer credit debt. I'll say upwards of $50,000 to $60,000 in consumer debt. The monthly payments on those were almost as much as a mortgage payment. Before we had this product, Rick and I came up with some solutions to get rid of that. That was a huge piece to help them qualify to get the next house. So this can also be used to pay off secured and unsecured debt to help them qualify to buy the next home. Because again, we're still going to hold their current mortgage payment. The only thing that we really have to hold against them in terms of a debt to income ratio is their current mortgage payment. But we can eliminate all the other debt that they have. I'll say all the other debt for the most part. Could even include an IRS lien. I have a couple of people that come to mind. This tool would have been good for them. Imagine getting rid of an IRS debt that you might have that's preventing you or hurting your debt to income ratio. All right, let's talk about costs. And I'm sure you have some questions. And again, I'm going to come back to your questions. If I'm going too fast, we'll go back to these slides. There's only about 15 of these slides. Yeah, 15, 16 slides. So the fee. So here's the fee. I mentioned the fee earlier. It's capped at $15,000. Please don't say, oh, that's a lot. Because I'm going to ask that you take a moment. Just allow me to put it in perspective for you. Here's a prime example. A couple that was thinking about using their IRA to fund the down payment. This happens. I talk to a lot of retirees that don't know how to navigate this. The financial planners don't know the financial tools. But imagine somebody taking $200,000 or $300,000 out of an IRA. The taxable event is going to be incredibly costly, so much more than what this contract fee might be. So this contract fee, by the way, is, now don't forget, we're doing a bridge loan here. The first thing I was talking to you about was primarily about the bridge loan. But what makes this work and safe is that our partner is also putting a contract together. That's the next slide. They're putting a contract together so that at the worst case scenario, if the consumer has not sold their home in 6 months, they will buy the house. They don't want to buy the house. They don't have to sell. So it's not like there's another, the other program that I'll use it. Many people are familiar with the term cash for keys. So another company doing that. We're not requiring somebody sell their house and turn over ownership of their house to another company. This is something that's down the line in the worst case scenario, where somebody can't sell their house immediately or within the first 6 months of this. That's where the bigger part of this fee is coming from. It's an insurance policy to make sure that beyond month 6, their house is gone. They don't have that primary mortgage. They don't have to pay back the equity loan because it will have been paid off when they sold their home. Again, when I go over this with consumers, the reality is, and the cold hard truth is that if they don't sell their house, if they don't do even the slightest bit of due diligence to sell their house, they're going to end up selling their house to our partner, and they're likely going to lose equity. But that's not what this is about. That's a fallback. Again, this is an insurance policy. So the fee is 2%. So if they're going to sell their home, let's say somebody lives in Hackettstown and they're selling a home, their current home might sell for $400,000. Or we'll say $500,000. 2% of that, they're going to pay a $10,000 fee. Gets paid up front. And there's a $1,750, $1,700 in closing costs. But then if they do carry that home, there's no interest on that money. So there's no interest on that loan that they've been lent for 6 months. So the fee also covers what would be deemed an interest payment. If somebody had an equity loan or an equity line, they're still paying interest. In the scenario that I used, or the example I used earlier, the client that went to his credit union, he borrowed $155,000 on a bridge loan from them. They're charging him 11% interest on that bridge loan. That's roughly $1,300 or $1,400 a month. So when you consider the cost of a equity loan or an equity line or your other more traditional bridge loans, those costs will add up. But you don't get the same benefits that you get from this. So these costs pale in comparison. And this, I will also say, putting this in perspective, we're in a market where I don't want to say we're desperate. I don't want to say consumers are desperate, but they're pretty darn close. Where the ends justify the means. People are paying $50,000 to $100,000 to $200,000 in some areas over the list price of homes today. We talk about people paying a lot of money. This is a type of market that just dictates people are paying a lot more for more than we've ever seen before. This piece is no different. But for what they get out of this, I mean, I wouldn't be hosting this in this way if I didn't believe that there's merit to this program. Again, this isn't going to help everybody, but it's certainly an option. Let's talk about the contract. So I mentioned that there's going to be an offer to purchase the property. The consumer, the client will certainly have an opportunity to review this contract. It clearly states if they get another buyer, before the 6 months that, and that price they get for that house is better, that you're certainly drafted into this contract language so they get out of this contract. This contract clearly states, I maybe could have done a clip of this. This contract clearly states that if they get another offer, that this offer would just simply be a backup offer. So they have an offer up front and then it becomes a backup offer. All right. So if you didn't put that together in 6 months, the money that we've lent them becomes due and payable. That would be considered like a balloon. At the end of 6 months, we'd pay off the primary mortgage, the bridge loan, because we'd be purchasing their home. So again, they do not have this house beyond month 6, unless they've got a contract in hand. It's unfathomable for me to think that anybody in this market that's working with any of you is going to have a property that they won't be able to sell in a heartbeat. And if they're not in a position, if they've got a house that's close to being condemned, then they're likely not in a position where they'd even be able to use this product anyway. And it would not be advisable to take this loan on, unless they just want to get out of that house, and they'll, if there's an agreed upon price and we're willing to buy it at those 6 months and that makes them happy and they don't have to do another thing, then great. It could work for them. That's an extreme case. I don't want to talk about extreme cases. I want to talk about what's most likely and what's most reasonable to happen and what's most likely and reasonable for people to be looking for in this market. So the way it works, the last bullet point, accessible at 6 months. Pardon me. Let's just focus on the 80% of the market value. That's where they'll determine a price to be 20% off of what would be considered the market value. And that's just going to be an automated, an AVM, automated valuation model. That'll be done online. There's no inspection or appraisal of the home. Here's an example of how this could work. $500,000 estimated list price on the house that they would be selling. The purchase offer would be 80% of that. It's 400,000. Outstanding mortgage balance, you can see 200. The departing property estimated mortgage payment. So the current mortgage payment in this scenario is $2,000. We are also going to collect those. We're going to collect 6 months of mortgage payments, so that's guaranteed money that's just set aside so that mortgage can get paid. Not the contract fee, as I mentioned before, happen to use the same $500,000, $10,000. The bridge loan cost. Now, we're not paying off any debt in this. We're not doing any home prep budget, as I mentioned earlier, as a part of the product. The maximum bridge loan would be $175,000. The bridge funds towards the new home, after deducting these expenses and mortgage payments for 6 months, would be $151,250 to put down on a new home. Now, if they don't need that much, now, of course, if they don't need that much, then they won't take that much. As it says here, the maximum amount needed to close on the new home. So they don't have to take this full amount of this money. If these 6 months mortgage payments are not used, the client gets that back in the form of a payment towards their mortgage payment. All right. So here, the 3 steps are get qualified. We have a qualification. So it's a separate qualification just for this piece. So we qualify them separately for this so that we can start plotting out and mapping out a plan for them to go buy their next home. The 6 months begins. This is an important piece, although you're rarely ever going to be getting this detailed with a client, but just so you have an idea, if somebody goes out and finds a new home that they want to buy, and it's a 60-day close, we're not closing this bridge loan until about, let's say 8 days, let's say a week to 10 days before our new closing. That's when the 6 months start. They're not taking that money out now, and the clock doesn't start ticking now. It doesn't start ticking until we're just about to close on our purchase. That's when the clock starts ticking. And they've got the 6 months. 6 months. If they haven't already listed it, and if they don't have it already sold by this time, which many of our clients do, list their homes, get it sold quickly, and do a simultaneous close. Majority of the clients that we talk to about this probably will not end up ever using this product at all, but it's a safety net. And then they've got, finishing out that timeline, they've got that safety net. Now we're lucky. We're in New Jersey. This product is only offered in markets where it seems feasible. Property values are at the point where it makes sense. We've got the demand. We don't see a decline in properties coming down, so it seems like a very safe bet. You can see the blue shaded areas, where this product is being available. Now, we can offer it to anybody in New Jersey. They can buy a house anywhere in the country, though. So the house itself that we're doing the bridge loan for has to be in these blue areas. I don't know how many of you are working in Alaska, Kentucky, New Hampshire, but if you got a seller that's moving out of state, anywhere in the country. I imagine Hawaii would be down here somewhere. All right. Our buyer qualifications is 620, minimum 30% gross equity. That's the amount of equity that they would need to have in their home already for us to entertain doing this. So if they have a house worth $500,000, take 30% off of that, 150. They'd have to have their current mortgage and debts on the house couldn't be more than 350. Otherwise, it doesn't start to make sense. And it's only primary residence to primary residence. And then listing qualifications, obviously, it's got to be in an area where you can list and sell a home. Vasa Park comes to mind. Some real estate offices struggle with listing homes in Vasa Park. It's the only thing I can think of off the top of my head because of some of the restrictions that Vasa Park's been known for those of you that are familiar with it. If you're not familiar with it, you don't have to pay attention to that piece. Aside from that, everything's a serviceable location from what I can tell. Listing limit of $1 million in most markets. North Jersey, we've been pushing that $2 million mark. And listings can't be for a manufactured home, a condo, or 55 plus community because of the deed restrictions that those come with at times. And we can tell you, endorse, articles in Wall Street, Bloomberg, Forbes, and here's my information. So I'm going to open it up. I see a chat. I'll start here. If the house value is more than 500,000, if the house value, Catalina, is more than 500,000, well, they couldn't get more than 500,000 out of it, and they could only get up to 75% of what the house is worth if it were owned free and clear. Sale cannot be a townhouse. Debbie, a townhouse, keep in mind, everybody, a townhouse, in most cases in our area, is just a different style of a condo. In most cases, like Willow Walk in Succasunna. Willow Walk, it might be a 2-story townhouse style home, but it's actually part of a condo association. If it's part of a PUD, if it's a townhouse style home, and it's in a PUD, you could do it in a PUD, because that's considered a single family home, and that's a homeowners association. But if it's part of a condo association, it wouldn't be eligible. Too many restrictions. This could be an evolving thing. This is a newer product, so that could roll out someday as this product gets more legs and more buy-in.